Hey traders, what's going on? Jamie Saettele here. It is July 20th, 2016, and fairly quiet U.S. session trading of late, but we do have potential still for this broader topping process to play out in the U.S. dollar, generally speaking. Just let me know if you guys can hear me quickly so that I can get started. AV is good from Pooja. How you doing? AV okay from Mark. Okay, great. All right. First thing we'll do is look at, I referenced this 2 days ago. It's actually here. It was before the big up day yesterday. So it obviously hasn't worked out to this point. But I do want to drive home the point here that you still have this relatively weak momentum going on with the US dollar index. Okay, so RSI on the bottom. A lot of people will talk about or point out divergence with an indicator, typically RSI, or RSI is a very popular one to do so with. And we do have, divergence, but what separates, I guess, the divergence that I'll pay attention to is that I want to have, first, when you're looking at an indicator and you're looking at divergence, the indicator, you have to compare apples to apples, okay? So, divergence has only the close, okay, in the calculate, or RSI, I should say, has only the close in the calculation, right? So you've got, if you were to look at the calculation for RSI, okay, you would see that you've got only closes here. There's nothing about the highs. It's only closes, all right? We're not going to go through the whole thing here, but only closes, and you need to look at closes in order to identify divergence, right? So divergence has a new price high and not a new RSI high, or a new price low and not a new RSI low. Now that can happen a lot, so you need to give it better conditions, right? And the conditions that I do like to provide are that you need to have RSI, or you have to have a 60-day, 3 months roughly, 60-day high or low for the price. All right, and then you've got to have RSI for a top be below 65, and for a bottom be above 35. That tells you that the momentum is really petered out, right? Because when RSI is at a relatively high level, you actually do, that is a sign of strength, not weakness. So on the charts that I show you, the magenta dots are the divergence signals that meet those, those requirements. And we've had several of them here since Brexit. 3, in fact. 1 yesterday, 1 2 days ago is one I pointed out 2 days ago. Obviously did not work. It's a warning. It's not a signal in itself. But a lot of tops really since last July. So actually, funny enough, since last July 20th, you've had a lot of divergence signals that have led to tops, right? Some have not. But more have than haven't, actually. And, on the run-up that we had, the only divergence signal you had was here in March, early March, which did not work, although eventually the market topped in March. So if you just go back on this chart and we look at divergence signals, I mean, it's fairly reliable. I mean, it's not a signal, it's more of a warning, right? It's more for color. to tell you if the market is trending strong or not. Like this bottoming one would not have worked out so well. Okay, but you get the idea. They work out fairly well. So that's what we have going on right now with the U.S. dollar. We have an uptrend, right? But we have a weakening, I should say, uptrend, or not a strong uptrend. So that brings me to the slope picture for the dollar. And we're pretty much talking about, at this point, just the channel that goes all the way back. And we have, I'll look at this on a weekly basis, right? I'm not too concerned really what happens over the rest of this week, but I want to see where this market is, where this slope is at the end of this week, right? So tomorrow is ECB, as we all know, and you could have an instance where the market spikes one way quickly and moves the other way even quicker, as happened in December and March, or it could be somewhat of a dud. We'll look at the euro in a moment here, but obviously what happens with the euro is going to have quite the bearing on what happens here. Okay, but this is a big area where we could really see quite a fake out, on this move higher in the buck. And what's more, this is the daily version. So what's more, if we bring this up, this is a chart from a little while ago, but you can see that we do have a fork that could come into play too. So again, on the daily basis, let's say we get ECB and we get, a quick euro, dumping, probably sends the index up towards the yearly open. So you've got 12.139, let's call it 12.140, and you've got a slope confluence there tomorrow with the downward sloping parallel year open price, and even this upward sloping 50 line. Okay, I'm not sure how much weight to really give to this, right? Because there's not a whole lot of inflection points on it. This, I guess you could say, there was resistance on this 50 line, but look, not that precise. You did spend time around the median line, kind of a fake out below it before going higher. Either way, I would mark down 112, 140 as a really big area for the US dollar index. Okay. So if we spike up there and then reverse and end the week below, that would be really bearish, in my opinion, for the buck. Euro specifically, if we go to Euro specifically, and I really don't have much to tell you about Euro. It hasn't really done much since Brexit. We've been in a really tight range, okay? But if we were to, take a dip here below the Brexit low, you'd be looking at, 108.72 is the year opening price for a response. Okay, I don't have a setup or anything here. We, had eyes on selling it back at 111, 35, 111, 15, 111, whatever. After, we had the move off of this on earlier in the month. We never really did anything with it because I took the orders out before they actually would have been triggered. But the idea, I guess, would have worked okay to this point, right? But we don't have anything here at this point. It's it's kind of a dud as far as a market here. Obviously, waiting on ECB. For a reminder, those that are new or may not have remembered, ECB. This was December. Okay. This was March. Actually, close to the closing level from that day. This was ECB, I believe, last October on the 22nd. So you can get some pretty substantial moves on ECB. but really very little to offer from a technical standpoint on the near-term picture for euro at this point, right? The special reports and all the stuff that I've written, I still think that the bigger idea is for a bottom. And again, not many people agree with me. That's okay. You know, but that doesn't mean that I'm long or that there's a trade here at this exact moment. All right. As we come in tomorrow for ECB, I would look for, again, about 108.72. The slope that the near term, that we're looking at has not changed. It's a 60-minute chart. Here's a 4-hour chart. Again, we're looking at quite simply the fork from the August high to the December low to the May high of this year ends up being the exact trend line, actually, okay, that you would be drawing from the May 2016 and June Brexit high. And 108.72, as you can see, this slope, which is magenta, okay, which crosses through a bunch of stuff, you would actually have that in line pretty close to the year open tomorrow, okay, during ECB, which would be right here. So, weekly opening price is what, 1045? Okay, so you could end up getting resistance at 1045 in the overnight, and then potential support on a downdraft down at 108.70, 109.10 or so. Would go closer to 108.70, just given that that's the year open, and it's a price that I over the years have learned to pay a lot of attention to. Other than that, there's not a whole lot to work with here as far as euro is concerned. It's kind of indecipherable from my vantage point. Dollar Swiss is actually somewhat interesting in the fact that you have this divergence going on with Swiss and euro. That is, euro's actually holding up much better than dollar Swiss is staying low. Okay. Again, here's the Brexit, right? Euro is still below its post-Brexit low. Dollar Swiss has actually been trending higher since the or since Brexit happened. So, that in itself is kind of a warning sign. I don't know if we pull off from here. This is, some resistance. It's just the parallel from the trend line back. It goes back to the high in November. An even better, more well-defined area would actually be 99.90 to 100.30. You've got at that level, could have something to work with here. But at that level, you get the 618 of the decline from November, year open 100.07, and then the two equal legs from the May low gets you 100.30. So we might be heading there at some point before you get the broader top for dollar Swiss and potentially Europe in general. But again, confidence really low. Not much of a setup for me at this point. Pound dollar, I still think the trade, I like it, generally higher, being bullish. You actually are starting to see the possibility of an inverse head and shoulders here, okay, since Brexit, which is interesting. Again, why do I like the upside? Well, you had the Brexit, okay, and then you've got this really long-term support confluence, as you know, okay. It's on the longer-term charts page, and been, kind of highlighted that for a while. And even, even a bounce into, I guess, what would be considered former support area, which is the line, the parallel from here, even a little bounce there gets you probably up towards the gap close of 136.49. Okay, so, that's not quite 500 pips from spot right now. And then of course we have the short-term pattern, and this has been in the last few updates, but 5 waves up from the low, and at this point you do have 3 down. Last night's chart, if we would have gotten a dumping into 29.65, you would have had potential for, I think, to buy it. But here we've got, if we go to a 15-minute chart, you can see that you may have an impulse up from this low this morning, or in Asia last night. 1, 2, 3, 4, 5. So you're seeing 5-wave rallies in cable at various degrees of trend, which obviously is quite interesting given the long-term area of support that we are trading on. And this could really set the stage for a major reward to risk opportunity on the upside. What I would want to see, let me just get rid of everything here except for a few slope lines so that I can make it clear what I'm watching for entry on this. All right. So this is what we got. Just the trend line off of the low. Okay, you can see that you've got super clean touch points on this, right? So this line specifically, I mean, it doesn't get any better than that. Okay, even yeah, we bought it, or I had an order to buy at it. I put the order on the swing update and bought at it. And it even held up there. You got like a nice, there's a 40 pip bounce overnight on that news yesterday, and then the market did break. We've come right back to it. So this is resistance here, okay? Not trying to, fight and buy into resistance, but if you were to get a push above this, okay, that's what I noted this morning on Twitter. If you get a push above this and then you pull back into it, then you're talking about the opportunity to get bullish and buy on support at that point. All right, so kind of doing everything for cable is based on what happens here, really. I mean, if you get another dumping here, then I guess you could get support down at this region. But, based on, again, the 5-wave move higher, from long-term support, I'd rather be bullish on this than bearish. But in order to buy it, you want to have a level to buy on, and they're just at this point, as I'm talking, there's no level to buy on at this exact moment in time. Okay, so push above turns you bullish, buy the dip if it pulls back to it. It's what my plan is. Aussie. Have talked about Aussie a lot over the last few weeks. Aussie's been acting really well over the last number of weeks, pulled back here the last couple of days, of course. Working with this slope here, even if the major trend is down still, and I'm not so sure it is, but even if it is, 74.50 is an area that you have to look at buying, in my opinion. You've got so much there. It's the 618 of the rally post-Brexit. Okay, 70.44 would be that. So draw your Fibonacci from the 624 low to the high on 715. You've obviously got a number of slope considerations there, right? Including just the trend line that goes off of the May 29th low and Brexit low, okay? You've got the month open right there as well. It's actually 74.47. If you were to look at just, take a step back, kind of zoom out, you would see that you also have some daily highs and whatnot around there. Right, so if I just draw 74.50, right here, right? You can see the highs that we've got going back, incidentally, to July 21st. Funny enough. So how funny would it be if we had support on July 21st, 1 year later? July 21st, it was resistance, 74.50. Kind of interesting. Okay. There was also this high here as resistance, so you look for it to provide support now. So 74.50 just kind of has, support, or I should say it has important level written all over it, right? When the market level that you're looking at is under the market, you look for it to provide support. When it's above the market, you look at it to provide resistance. And, you don't know if it's going to hold or not, but you have to know what you're looking for. And in this case, I'm looking for support to hold at 74.50. So if we were to trade down there, get a response, like for example, this is a 4-hour chart, okay? You can see the 4-hour candle, which actually just closed as I started this webinar, and we have a nice bullish key reversal there. All right, is that a low of some sort? It might be, but again, if we would have made that reversal down here on in the 74.40s, 74.50s, I'd be much more likely to just buy it at market, right, with a tight stop under the low, right? Here, I'm worried about one more run on it because you didn't hit support yet. Okay, that's just the way it works. Someone else might say if I go to a 60-minute chart, you might add in, well, this is a 5-wave decline here, right? 1, 2, 3, 4, 5. That is true. It is a 5-wave decline. So I said, wouldn't that actually be bearish? Could be, but again, there's excuse me, there are so many possibilities, including expanded flats, in which you get a B wave high and a C wave low, and in this case you could have A, B, C. Okay, that's the problem that a lot of people have with Elliott, and that's fine, that's okay. You kind of have to, learn how to use it, I think, practically rather than just textbook like or theory like, and in the real world, you get 5-wave declines that complete corrections, at larger degrees, especially flats quite often. So, another trick or rule that I've kind of learned over the years is that if you have a trend change, in this case, I think we have a trend change towards the positive for the Aussie dollar on a grander scale, fade the 5-wave declines. Okay, 5 waves down, fade it. Even if it doesn't complete a flat, you could still work higher off of this level and get back to 75.34, 75.75 at a minimum for resistance. Okay, so that's kind of a real world application of Elliott, not just textbook nonsense. Okay, Kiwi, what is going on with Kiwi? I guess, we were right to be looking on the short side on Kiwi because of this chart, right? This is a chart that I'm sure you're very familiar with. And we've pulled off, obviously substantially. High being 73.20. Here we are 300 pips lower in the course of 1, 2, 3, 4, 5, 6 days. So what now? Well, I thought this was interesting. I was kind of trying to figure out, or make sense of the recent Kiwi drop. Because look, it's kind of been a straight line. You've had very little in the way of consolidation, right? And what I thought was interesting was that if you actually draw this trend line, okay, which is basically the year's trend line, so you're going from the January low to the May low. Okay, take the parallel of that and connect it off of the low from August, and it's actually kind of like perfect as far as going, from the August low, goes through some big lows, November low, nothing for a while, then recently, kind of important stuff. Okay, so to me, I'm looking at this area, consolidation around here is fairly important. You do have, today, you have what's it called? Stability report or something like that. What is it? RB&Z update on its economic assessment is at 5 p.m. New York time. Again, that's it's when it's right the rollover. RB&Z does a lot of stuff right at 5 o'clock. It's kind of annoying because you get all kinds of bad liquidity not around that time. So you get widen spreads really big time. Okay, and it's typically not the best time to trade, but you do have that coming up, so do be aware. I don't know what they're going to say or do, but your Kiwi's going to move. I know that, right? And for me, it looks awfully weak right here, trading around this level, but I would just be aware of, getting some sort of a liquidity-driven move back up into resistance, which I would put at 71.30.50. Okay. Now again, Aussie Kiwi might actually be the clearer Kiwi cross to look at this point. Charts from the last few days on Aussie Kiwi, I think Aussie Kiwi's headed a lot higher, but here's the bearish slope we have, and we actually did come into it yesterday, right? And it was resistance, and the idea now is to watch for a pullback into support. And your best level for support is probably going to be this parallel right here, this former 50 line, because it is former resistance, right? So if you were to get that, if we were to get a pullback of that magnitude, it actually puts you all the way down. It actually puts you all the way down towards 104.50. By tomorrow. So I don't know, if that's going to happen. That would probably take a pretty big Kiwi bounce and Aussie to maybe limp lower into support, but it's certainly not out of the realm of possibilities. If we don't get down there by tomorrow, then it might end up being something more like a slower, type of corrective move that extends into next week and it gets you into 105.40. Either way, Aussie Kiwi to me is bullish and is turned up. And the idea, I think, is to be buying dips into supports. Okay. So might be paying more attention to Aussie Kiwi than just Kiwi dollar, just because the levels are a little bit cleaner, I think. Dollar CAD. Obviously, was not triggered yet on a long. Remember, we're looking to buy this. I've been thinking that the eventual break on this is going to be higher. Couple reasons, again, for that. One being that you do have the seasonal period for crude oil and commodities in general is fairly weak, throughout August. It's not a straight line, obviously, but generally speaking, you get bigger down moves during this period. So, you kind of want to align yourself, I think, with the surprise factor, which, historically this time of the year into August, the surprise factor is on the downside in commodities, which obviously is, going to drive commodity currencies. So that's what I'm thinking as far as dollar CAD. Also, simply the fact that, you've got a relatively constructive price chart for dollar CAD, it would seem, with the strong move off the low in May, the big reversal, okay, followed by coiling price action, okay. We've talked about the importance of the 20-day average for, for dollar CAD before, and Oops, can't see that color probably. So here's the 20-day average in black. And, when dollar CAD goes into a trending period, it does tend to kind of hold its 20-day average, right, as support and resistance. Even back here on the way down, earlier in the year in March and April, obviously in a range, you're going to go through the 20-day average many, many times. But here we are back above it. So if we are going to, make that move to the upside, not a whole lot of room for error here. You want to see the market stay above that 20-day. And for me, I still think that it's, the 2980 area does look like an important area to me. And the reason being, again, here it is. It's that really high volume level, one of the highest volume levels we've had, okay, of the year. Second for an hour behind only the day after, or the day of the top, which is the hour right after we made the top, which was back on January, was it 18th or 20th. So, it's a big area. It's going to be your support and resistance inflection point moving forward. If you want, I guess you could force an Elliott wave count on this. Don't really like doing it, but if it makes you feel better, you could say this is 1, 2, all right, 3, 4, 5, maybe going A, B, C, or something like that. And what you would have as well is a wave count. Okay. 50% retracement, 2977. Pretty close to 2983, obviously. If you were to get, let's go even shorter term, 15-minute chart. I don't know if we have any sort of a minor B wave top in place here, but if you did, you would actually have two equal legs. Holy crap, 29.83.5, right at the exact level. So, might be a level to watch for the next day still. Probably worth keeping an order in there at the 29.80 region. There are some other crosses to look at for CAD too. For example, you've got Aussie Cad. Remember, we've looked at this for a while, but Aussie Cad broke out of the structure, the bullish structure that it had for so long, and is actually pulled back and trading around a level that used to be resistance. Okay, so Aussie Cad continues to to act constructive in my opinion, as it's pulled back from a relatively kind of frothy level after the run up. You've got Pound Cad. I know Mike's talked about this one on the short-term charts in the morning webinars, but if we look at a 60-minute chart of this, I mean, this one looks probably maybe even better than than pound dollar, right? You've got the possible inverse head and shoulders pattern here with the right shoulder as a triangle, clear as day on that triangle. Watch for support near 170.90. Okay, watch for support near 170.90. Right down here. You got the week open at 70.70, but watch for support at 170.90. As I prefer or like much more to simply trade the individual legs of the crosses. In other words, dollar CAD and pound dollar separately. But this is a pretty clean near-term pattern. Near-term price action is pretty clean for pound CAD. Let's move to dollar yen and some yen crosses because they are getting into interesting levels. So dollar yen, last week we had talked about the and mentioned the 13% below the 52-week average, right? And how we had probably made a pretty decent low in dollar yen. And this was that chart, right? You have the blue dots again, 13% below the 52-week average. Okay, and so what we did was we actually, I took the analogs from the last three, instances and kind of compared the overlay, and that's what these are, right? So the idea was to look higher, kind of look for a Monday to Friday high. We appeared to have had it as we got a key reversal on Friday, but of course we've just gone in levitation mode higher for dollar yen. So, I was hoping that we'd be looking at coming into today, Wednesday, and be looking at actually covering shorts and going long. But, as is almost always the case, the market did not adhere to its past scripts perfectly, so thrown off a little bit. I wouldn't chase right here, though. You do have pretty big important levels that we're trading at, as I'm about to show you. And here we go with that. So indicator wise, you've actually got $55-day average. Okay, each time we've gotten above here, it hasn't been smooth sailing, let's put it that way. Only time we've gotten above here this year, as you can see, January, that was this right here was the negative interest rate policy, NERP. Okay, and we all know what happened there. The next so-called breakout in May, and then we know what happened there. And now we're back at, again, 55-day average or just above it. Okay, you also have RSI at 60. Okay, and again, each time RSI has gotten to or above 60, you haven't had too much success. So while I think the dollar yen heads a lot higher over the coming months, probably mid one teens, right? Let's call it. You could get up to 114, 115. I don't think that would be out of the ordinary at all. I do think there's the risk of this thing pulling back, into 103.50 or so. And if we look at the daily slope picture, just the price chart, excuse me, you can see this fork, right, that we're rallying up on, continuing to fail on the 50 level, okay, and you do have the Brexit high right here. If I look at the Nikkei, which is going to look very similar, obviously, to dollar yen, you do have that level itself is at, what I would consider a fairly well-defined resistance point, simply off the trend line that you've got from August 2015 to December 2015, and then it's a parallel. Okay, so dollar yen to me is a bit stretched up here, and I'm, looking for this thing to turn around. Tried to short earlier in the week, didn't play, and at this point, I'm, not just wanting to sit short and fight it, but rather just not buy into it, right? Here's the 4-hour chart. Again, it's just a, it's just a little melt up. It's, just kind of a real low momentum, low vol melt up, and we're just trading right at this resistance area. So You can continue to watch for maybe resistance on the upslopes here, but the key for me would be if you start to come off, watch for a support break. You might try to catch some on the downside down towards that 103.50 area down here over the next couple of days, which brings me to the S&P 500. We just saw the Nikkei, right? What about the S&P 500? Put this chart out. 2,200 still seems to be the magic number as far as a bigger pullback would be concerned. In the meantime, the market has followed these slopes pretty well. Presented this, I think it was earlier last week that we had put these out, or maybe after we broke the highs and we talked about going up into 2170s and then pulling back. And we did. The pullback super shallow, holding this parallel, okay, and slope off the high here. And I would be watching for a few more gyrations within this relatively tight range before you get the potential for a bigger move out of it, which will probably be higher on a last gasp small fifth wave move. But what you're looking at here is probably a Elliott triangle, would be my guess, right? Maybe an A, B, maybe tighten up a little more. You could get a flat A, B, and then sell off down and test the lows. Not sure that's going to happen. Either way, just follow these slope lines, okay? You're coiling in between here for a final move up into probably 2,200 before the market can kind of relieve itself on the downside. So that's what I'll be looking at with the S&P 500. And in this, if you're looking at it this way and considering dollar yen, I mean, look, we're like a 2 points or so from resistance on the S&P 500. Okay, right up here. What else do we have? Oh, Euro Yen. Let's take a look at Euro Yen. This might be something to consider heading into tomorrow. So, funny enough, on Friday, remember we actually had one to buy right here, like 116, and that would have triggered, right? I came back to the desk late in the day, and I saw on Friday, it's just Friday, like nothing's happening, and I saw the Turkish coup thing happen, and I was like, oh crap, here we go, and dollar yen just took a dump, and euro took a dump. Euro yen was really took a dump, and sure enough, come back the next week and on Monday, and it's really nothing, and you end up rocketing higher. So if for some reason you actually ended up with that trade, you kind of lucked out, and you'd be sitting pretty right now, actually getting it at 116, currently 117.40. I am looking though for another Ahmed has a question here. I'll get to that in a second. But I am looking for another drop here. Okay. I do think you have a pretty big low in place for Euro Yen. Talked about that on the swing update going back. I guess it was from maybe the 10th or so of July. Yeah, check out the 710 post. So I do think you have a pretty big low in place, and you're headed a lot higher in the coming weeks, months, and probably longer than that. But near term, over the next few days, looking for this as an A wave, a B wave, and looking for a lower C wave. And it would fit pretty well if you got this into ECB, which, by the way, all this intersection is right at ECB, the lower parallel. Okay, and as you can see right now, you are kind of trading on this area, this sliding parallel, which was pretty good for support back last week. Obviously, the Turkish thing, you kind of went through it, but it ended up being support again earlier this week. So I am looking for, kind of a final, dip to throw everyone off, which would be a C wave and Elliott, before euro yen can eventually go higher again. So that's euro yen, one of the more interesting crosses I think right now. Ahmed saying, what about S&P 500 2160? 2160. I think we're well above. We're at 2175 right now. So I'm not sure what you mean by 2160. You basically have these lines at 2177 and 2180 or so. 2160 resistance, though. I mean, 2160 is down here, right? So we're well above 2160. If you're unfamiliar with why I've talked about it for months and months, but why I think that you have the 2200, why that's so important is this is the monthly chart. So this is the slope on the monthly, and we have 2200 up here, sliding parallel, and then the time factor, of course, which is July of 2016, 9 years difference from 2007, 9 years difference from 98, default, Russia, etc., etc. So there's a lot going on up there, time and price for 2200. All right. Oh, gold. What about gold? That's, gold's silver chart. So here's the gold chart. We have pulled back from the 2011-2012 trend line. Gold first possible support in about $10. Today's low is actually 1313. You could get support near 1307.50. Again, that's the high from January of 2015. I do think better support might actually be down near 1270 though. Okay, and reason being, you've got downward sloping there. It's a parallel, which was precise resistance in May. And then if you've got just a simple new trend line off, recent lows from this year, that would put you down here 1270, maybe closer to mid-August or something. I do like the idea of gold going higher, but again, you're going to have big dips within this bull market. Even back when you had, look at a log scale of, say, the early stages of the bull market back in the early 2000s. I mean, you had some significant declines that lasted a couple months, okay? So you're going to get big drops, okay? And for the most part, just a simple trend line would have helped you out pretty well. Right? So, do that here. Follow that trend line, and follow these inflection points, parallels that cut through the May high here. Okay. That's pretty much it for me. I mean, it's, the other thing that I did want to point out on the stock market, and this is still the case, it's been the case for a while, I don't really hear anyone talking about it, but so you've got the S&P 500 at these highs, right? Small caps are still well below their highs. It's a small cap index, okay? And we're actually getting pretty close to resistance, funny enough. So, oh, how do I do that? So you do have a divergence between these, all right? And the resistance is not that much higher. If I look at it on the daily chart, okay, it's, it's really like a point away. It's not very far away. So I would pay attention to this chart, which is IWM. It's the Russell 2000 ETF. All right. Again, if you get up into there and turn around, you might get a pretty nice drop in dollar yen. With Nikkei up here and the S&P 500 getting up into that resistance we just talked about. But other than that, yeah, I don't have a whole lot to talk about here. The big things I'm waiting on, this Aussie dollar support, 74.50. I think it's a biggie. Dollar CAD support, 29.80s. I think that's, could offer a chance to buy it to kind of front run the breakout, if you will, on the upside. If it's going to happen, you're going to hold 29.80, I think. Kiwi dollar, it just looks terrible. It can get the smallest bounce, but you want to look for any sort of a short covering rally to get short. Right, so people that short at bad prices will have to endure some pain, and if we get that short covering rally, the place it's going to stop is 71.30, 71.50 before it goes lower. Watch that Aussie Kiwi chart, the big levels there we talked about, and Euro 110.45 because ECB is tomorrow 110.45, and then maybe 108.70 or so, which is the Euro Open for support. But Euro Yen's probably even the better chart to look at because you do have a defined wave count there, looking for that C wave lower. And here's that chart again, right? So here we are looking for failure, looking for us to come off into ECB, and then you could go higher from there. So those are the thoughts for now. That's about it. And I'm going to get this up in archive for everybody, okay? All right, so thank you everyone for attending, and have a great rest of your week. I hope the weather's beautiful wherever you are. It's really nice here in New York right now. It's not too hot, nice and windy, sunny, and it's just beautiful outside. So have a good one, and we'll be out with the updates as always throughout the day. We'll be on Twitter early tomorrow for ECB, sharing any thoughts or trade ideas. All right, so take care. Bye-bye.